Today is Tuesday, May 13th, 2 p.m. Eastern Standard. I'm going to do a quick market update. Starting with the S&P 500, and I want to draw your attention to the recent sell-off, and I want to compare that to the amount of time to which we lost in just that one quick sell-off. So I want to draw your attention back to 2021, okay? In 2021, the market had a short-term top, and I'm going to try to get my line drawing tools here. We'll get a horizontal line. Market topped right around there in end of 2021. Now, the market, if we also pull this thing in, I want to show you where we go in terms of the recent bottom, right around there. Okay, so we're looking at the recent bottom. That sell-off that we just ran through from April of 2025, that brings us all the way back to about July 2021. Okay, so July 2021, prices were the same as where they sold off to in April 2025. So what does that mean? Well, let's take our quick ruler tool here. And forgive me, this is not going to be perfect, but I'm going to give it a fair shot. We are about neutral across 1,290 days. 1,290 days. The market's at zero. That's 3.5 years of gains that have been neutralized in 1 month. Right there. That dramatic sell-off that started really in February and ended in April, 3.5 years of gains gone. Market usually averages about 8 to 10% per year, depending on if you're adjusting for inflation. 3.5 years gone in basically really 1 month, but about, we'll call it February, March through April, maybe 2 or 3 months, okay? Now, when I looked at that, I said, we don't know where the bottom's going to be. This thing could head lower. I mean, there's some opportunities. It could have headed back to October 2023. It could have headed back to the lows here in January 2023. We could have headed even lower. There were some opportunities. This market would have gotten even worse, but I was starting to massively accumulate in this range. I mean, the dramatic sell-off, and the other part I want to talk about is why did the market sell off? And the main reason this sell-off occurred, and some of these large red candles, was due to man-made tariff geopolitical issues. This was not similar to COVID in 2020, where we had an actual virus that could have theoretically wiped out humanity, right? I mean, that drop was it was a bit steeper here. We're looking at 30% in a couple of days, couple of weeks. And it wasn't, the height of the tech bubble, end of 2021, where we saw a 23% correction, where valuations were crazy, venture capital was flowing everywhere, and there was really, if you had an idea, you could raise a few tens of millions of dollars for nothing, no backing or anything with anything real in the company. You could just go raise tens of millions of dollars. Those valuations had to come off. Here you can make the same argument for PE ratios in big tech and some of these large S&P 500 companies that we were at high valuations, but this man-made drop of 22 to 23% over tariffs, over something that we created. We didn't create COVID. We didn't artificially create the VC bubble and the tech bubble there in 2021 into 2022, but we did create this thing. So to me, this would have been short-lived. And I'd been saying that for a while, and I've also been indicating that in my actions by buying down here at the lows. And now we're already back up. I think it's 21% today. 22%. We're already back. And we're actually only off of all-time highs by under 5%. Okay. So I just want to draw your attention to that, and I want to highlight that you should buy the dip. You should always buy the dip. If you are in this game long enough, you will want to continue to accumulate and buy the dip and hold equities. There's the whole Bogleheads philosophy. I don't know the specifics to it, but it's basically a bunch of people who follow only buying the S&P. That's it. No balancing of the portfolio, no all-weather portfolio, no commodities, no gold, no NASDAQ, just buy the S&P. And those people do really good. They make good gains. Their risk-adjusted returns, they're pretty good. I mean, every once in a while, every 3 to 5 years or so, you're going to get a 10% correction. Maybe every 5 years, you're getting a 20% correction. Markets are still going to average 8 to 10% per year. Those are some good returns. And all you have to do is buy S&P. And when you get the chance to buy S&P at a 23% discount, you damn well better buy it. So I just wanted to talk through that. I think it's really important to highlight that buying the dip almost always wins. I've highlighted this in a number of weekly reports, and that has continued to be the case. It's not the end of the world unless you're betting that it will be. Anytime soon, you're probably going to be wrong, and the markets will recover. So the other thing I want to highlight that's very on a very similar topic here is going to be the commitment of traders data. And I first want to draw your attention to the commitment of traders data here, and this is credit to crowdedmarketreport.com. We have some of custom look-back periods that we look at when we index the commitment of traders data. But what we look at is commercial traders versus large speculators versus small speculators. Think of a commercial as a hedger. It's a bank. It's somebody that is hedging prices. So they're, if they're buying and they're going long, they're hedging the fact that prices are going to go up in the near term. If they're hedging and they're selling short or they're shorting the market, they're hedging that prices are going to head lower. And we usually want to side with the commercials. And for the large speculators, those are typically going to be hedge funds and money managers, and that's the blue bar chart on these charts. And then the yellow is the small speculators. It's people that are not institutions, but it's retail traders. It's the mom and pop that are going and buying stocks, buying and selling stocks and options, and so on and so forth. They don't have enough capital to identify as a large speculator, but they are not a commercial. They're not a bank. They're not hedging. So when we look at equities, we actually want to follow the commercials. We've backtested this. We've seen that following the commercials is the best way to really profit in the equities market. But it is always interesting to look at the large specs and the small specs and see what they're doing, more specifically the large specs. And we typically want to fade the large specs. So I think the most interesting part of this, and another thing worth noting, is that large speculators, hedge funds, money managers, they're trend followers. They're not trying to catch reversals. They're not trying to get in on the bottom of the move and catch a reversal. These guys are trend followers. They are following whatever direction the market's going. And this report and this data was as of Tuesday of last week. And so this is going to change, and we're going to find out on Friday what the data looks like as of today, actually, since Tuesday is the day that the commitment trader data is indexed until, or kind of measured until. But the interesting part here, if we look at the S&P 500, as we've been moving up, and I think at the time of this data, we were probably up about 15% from the low, the large speculators were still short. Now, this is an index, so 100 is max long and 0 is max short. The large specs and the small specs are on the S&P 500. They're almost max short, which is crazy. And what does that mean? It means these guys are going to have to get back in and start investing again. They're trend followers. They're going to have to get in and follow the trend, which is now predominantly up and very clearly up. So these guys are going to have to get back in and buy at high prices and drive this thing even higher. So this makes me extremely, extremely bullish. And I want to draw attention to these other charts here. So the S&P 500, this is another view of the commitment of traders, but this is now absolute values. This is not the index. So we're no longer picking a look back period. We're actually just looking at the absolute values of positioning. And we can see in the more recent moves here, the commercials bought the dip and the large speculators sold it in the S&P 500. And it's actually similar in the Russell. So the Russell more recently has been a buy for the commercials, and the large specs are selling it. Again, this makes me very bullish, and this leads me to believe that there's a lot more upside to go in this market. Now, it doesn't guarantee that the market is going to go straight up, but it does indicate that speculators are going to have to get back on board. They're going to have to buy back into equities. They're going to have to do it at much higher prices, and that's just going to drive us to all-time highs and new highs. So worth noting and worth taking a look at. And on the S&P chart here, you can see I've got the indicator that shows that we're actually set up to go long, and we'll talk about some of our futures trading shortly. But I do want to talk through some of the key stock picks that I've been analyzing. And the first one is going to be AMD. And if I just switch to my stock layout here, go to AMD. AMD looking really good here, looking like a good setup. If we look on the daily chart, I've got a couple of things. I'm going to get rid of one indicator here. We've got this BX trender, which I find is an interesting sort of volatility indicator here. We only want to trade when this thing is green, and we usually are looking at this thing on the weekly and the monthly. Weekly's green, and monthly is probably getting close to, it's still red there for AMD, but weekly is still very much so in the green now, which is a very strong indication for us to be buying. I think AMD has really not been in the spotlight when we think about NVIDIA and all the action from NVIDIA and everything that's gone on with NVIDIA lately. AMD and Intel have really fallen to the wayside. Intel more so, the CEO stepped down, they've got all these kind of things that have changed for them, but AMD is still a very strong company, and yet we've sold off dramatically. I mean, if we look from all-time highs to where we were down about 65%, and we're still down about 50%. Now, I'm in on this position a little bit under 110, so I believe somewhere around 100 to 110. This thing's gone as low as 76. I've got some options baked out for January of 2026. We've got plenty of time here to recover, and this thing is just setting up really nice. I mean, this looks like we are getting ready for a break to the top of the channel, and then possibly a breakout, which could have us maybe even as high as $200, which would be amazing. The other I want to draw attention to is Micron. I actually just took some profit yesterday on options contracts here, and we're continuing to head higher. I've been sort of swinging this thing lately from selling at the swing highs and buying at the swing lows. I think I was in at around 70 at one point and then out at around 110 last time. On the earnings beat, I believe, around here, maybe 103 to 105. And now we're right back up to 97. I like Micron here. I think Micron has some room for us to get back to the top of the channel at 105, 110. And if we break out of this little chop here, I mean, there's a lot of room for us to head higher. If I can get one of these drawing tools and kind of remember where it is. When I draw a quick square, didn't even know they had, let's see, a rectangle. We're chopping around here. Here to here, I mean, a measured move on that would probably get us to, I don't know, somewhere around 135. I could see that as a decent price target. So that's Micron. Wayfair, overly beaten up. Tariff news. Looks like we're actually neutral on the day today. But tariff news, a lot of their inventory from China. They're a major kind of furniture wholesaler. They're down pretty significantly off the recent highs. We were down 77% at one point. We're down 56% right now. This thing has plenty of room to head higher, and I like the financials. I like the balance sheet. Things look good for them. PayPal looking pretty good as well. I would be in long on these as well, or on PayPal. Broke through this falling wedge. We're probably going to head at least back to $76, if not higher. I like Baidu to about $100 now. We're in, I think, around 80 to 90, and I'm looking to sell as we get closer to the top of the channel here. Just really more for me. One, it's the technicals. It looks like we'll probably hit some resistance around 100. Two is it's a little bit overweight in my portfolio for emerging, or what I call emerging markets, Chinese company. So I'm looking to reduce that. The other is Qualcomm, another one of these semiconductor companies that's just like overly beaten up, and I think has a lot of room for upside potential. If we look again, we're sold off down, 47%. Now we're still down about 32. These are all NASDAQ companies, NASDAQ 100 companies. So we're looking at things down like 40 to 50% on some of those recent ones I just pulled up. And the NASDAQ is only down what? We're at 21,290 on the day. NASDAQ's down 6%. Like these other stocks are down 40, 50%. There's some really good opportunity. Coinbase, another one. I wish I was buying more of the dip, but I was already a pretty heavy position, buying around 220, 230. We got as low as 144. Now they're getting added to the S&P 500. What do we see? We see a gap up today, 23% move in one day. For those of you that follow me in the Discord channel, we've talked about this one. We're still down 26% from all-time high. And this thing dropped at 1.60% after an earnings beat, which is the crazy part. You got to really watch the financials on these companies. You have to see, some of these things are overly beat up for no good reason. Future forecast, hey, we don't think Bitcoin or, Bitcoin's down and people aren't going to be using Coinbase as much, but earnings were a blowout for Coinbase. So it's like, why are we down? Why are we down 50%? And then same thing for Five Below. This is actually a dollar store brand. I'm sure they'll have some impact and challenges from the tariffs on China, but assuming we're alleviating some of those pressures and having some trade negotiations, this thing could go up. And we're down 75% at one point. We're down 50 still. I'm in this around $85. So off the lows, we're already up 100%. Am I reading that right? We're up 100% off the lows. Incredible move there. 100% off the lows. Went from 50 to $100. So yeah, those are the stocks that I'm looking at. Now let's talk through our trading futures positions. And I apologize if this screen is a little bit cut off when I transition over here, but current mix for futures positions that we are looking at and things on the watch list. I'm currently in long Bitcoin. That's a momentum trade. I'm watching Ethereum, which is now also a momentum trade, but not something that I've actually gotten in. I'm a little bit heavy on crypto with Coinbase and Bitcoin holdings and Ethereum holdings. So I'm not going to get in on the momentum trade for Ethereum, but I'm in on Bitcoin. I'm in on the S&P long, and I am shorting the Japanese yen. All of these trades well in profit, and the yen is the only contrarian reversal trade. Commercials were max short on this, speculators were max long, and we finally saw a reversal while the market started to pick up steam. S&P was also, to me, a reversal, so I got in long on that. It's more of kind of a half and half position, half ES and half a yen short, and then a full size position on long Bitcoin, which is well in profit as well. I think we got in right around 90 to 92,000. So those are current key positions. And then I'm looking at the dollar, maybe to get an entry here to go long. Commitment of traders data supports it. Looking at the Swiss franc, which may be something that we get in short. I like the commitment of trader data setup on it as well. That's pretty much all I'm seeing. There's not a ton that's set up from a commitment of traders standpoint. And last thing I want to highlight is my current portfolio positioning and mix. So more just kind of theoretical here that I want to chat through. With my portfolio, I had sold off, and I'm going to pull up a chart to better highlight this. And this is actually going to be the chart on TLT, which is the 20-year Treasury bonds. I sold this thing at 94. Now, this was actually in the overnight session. I sold at 94 my entire holding of TLT. I was actually in the red because I had accumulated some of that position back in 2024 and some previous years where it was a lot higher. It was a small loss, not a big deal. I rolled this over into that dip buy that we talked about in VTI, and that's up 21%. So we got out at 94, It's down to 85. Now, I do want to say I like TLT here, and I'm going to probably start accumulating over the next couple of weeks. I'm going to pull up a 10-year chart here. I mean, we're near some deep lows that we have not seen since, what is this, 2023? And I don't even see it beyond that. I don't see anything lower on TLT than recently in 2023. I could see a double bottom here. This thing's not super correlated to the S&P, so if it goes down or if it goes up, it doesn't really mean the market has to be going down or up. So I think there's some great opportunities to be getting in TLT at the swing lows here. Anything below 86, personally, I like, and I'm going to even draw a zone. This is my trading zone. I would be buying TLT at these prices anywhere in here. I think is a great opportunity for hedging your portfolio, 5 or 10%, maybe more if you're closer to retirement age, but that is what I would be doing. I'm going to flip over to GLD, which is something I also scaled out of completely. We've just gone parabolic here. TLT, I think, has run something like 20, 30, 40% this year, so I'm out of this position as well. I would like to get back in, but I am not buying at these prices. I will wait. I'll run some sort of Fibonacci, and let's say from here, Fibonacci to there. I'll wait until a pullback to, maybe around 237 to, and we may not get there, so I may not have any gold, which is fine. No gold exposure. Anywhere from 240 to 215, I would be buying gold, just as far as a hedge. So as the market continues to go up, maybe gold will continue to go down as kind of tariff news de-escalates and trade wars de-escalate. Gold may find itself a deep correction, and that is when I would be buying. This is just going back to the end of the year. I mean, this is just 4 months ago, so it's definitely not impossible for us to erase those gains from 4 months if the market breaks all-time highs and a lot of the volatility stays low. So I'm not going to be in gold right now. I've got an ounce of gold that I've bought a year and a half back, which is worth $3,300 an ounce. I am not adding at these prices, but it's something on my radar for when we pull back. So that's my overall thoughts on the market. I am still heavily in equities. I'm not in TLT, but I will be accumulating at these prices. And now is really just some profit taking and rebalancing as we go and I think head to new all-time highs. So that's my thoughts. I would be probably, I would have been buying the dip a while ago. It's hard to say I'd be buying now when we're 5% off all-time highs. I'm still bullish equities. I still think we have a long way to run higher, but I also am starting to like a little bit of a hedge in getting into some TLT exposure at these prices. So what I did is I was rotated and a little bit levered, and I was planning on going heavier if we kept dipping further. We did not. We bounced. So now I'm at price points and target prices for certain stocks that I've picked where I'm now selling those for profits, and I am rotating to cash, and then I will be rotating to some TLT exposure over the next couple weeks, next couple months. So that is a long update. There's a lot of things to talk about, and I hope you guys found it valuable. Feel free to like, subscribe, and join us in the Discord where I post trade alerts and also keep you posted on anything, whether it be related to the market, stocks, futures, commodities. Those are kind of the things that I cover. So appreciate you listening, and we'll talk soon.